Three, two, one. Welcome to the show.
All right, welcome to the show.
How is it up there in lovely Massachusetts?
Well, hopefully I'm far enough away from the camera that you don't see me literally melting. Uh,
Poor Jay.
I mean, my glasses are steaming up. It's I don't have any air conditioning in
Yeah, you're in.
this.
He's in an
I got a
old,
little
old house. What is it? 1632 or something?
uh,
What is that?
1850-ish.
That's
Yeah,
close enough.
there's a couple of yeah. There's an AC. I got a window AC box in my bedroom. That's about it. So I'm in this little room off the back, and there's not even a breeze right now. It's just yeah,
You
I'm
know,
just melting.
if I was up there right now, it would literally be a puddle of sweat too. So that'd be worse.
Oh, we'd be in the ocean, bro. That's
Yeah, would be. All right,
yeah.
man. What do you got for us this week?
All right. So it was a pretty crazy week. We can talk about it a little bit. It's so TSP weekly podcast, 30 July 2023. Uh, Fed meeting was a highly anticipated 25 basis point move, which we did get in the Fed meeting. We'll get into that a little bit. Last week we talked some about sentiment, and I got some slides that we did last week and some additional ones. And we're going to basically look at sentiment from a couple of different directions. Bonus chart is FNGU, which is FANG up. Um, there's also a FANG down. This is a 3 times leveraged ETF. So if you think the FANG stocks are going to keep going higher from here, this is a way to really essentially triple down on your FANG exposure. And then we'll take a look at the TSP weekly charts. So before we get into all that, we got a comment. So this person is a member of our site. Um, he commented on the 23rd of July newsletter, so last week, and he says, "I read your article." He's talking about the newsletter. He says, "I feel like the market will pull back. I've been in the S fund since November 2021. I moved to the G fund today," which when he commented, it was the 24th of July. And I basically responded with something to the effect of the the part in there that the kind of makes me uneasy is the I feel like the market will pull back. I feel anything is kind of the antithesis of technical analysis. The idea is to use the technical analysis to manage those feelings, and so this week actually was probably a pretty good example because on let's see, the Fed meeting was Wednesday. On Thursday, the market gapped up really high and then reversed and came all the way back down. The C fund finished 6/10 down on the day. It was also the end of the 13-day winning streak for the Dow Jones Industrial Average, um, and so there was a lot of angst in the market on Thursday night. If it had gapped down Friday, it could have been the beginning of a new move down in the market. But Intel came out with good earnings, and so Friday was a really strong up day. So the problem with that is if you feel like the market is gonna pull back and you get a day like Wednesday, that makes you feel really good. Or sorry, like Thursday, right? The market went down, it makes you feel really good. But then Friday, it goes back up and it's higher than it was on Wednesday. So you just get jostled around if you don't have guide rails to help.
Right, and
And
what we
so,
hope is that we go from Um, I feel like, and that just may have been the term he used, right? Maybe it wasn't as
sure.
much of a gut thing. Maybe he did have a plan. Maybe he just didn't articulate it. But since we don't know, and we got, and I think a great comment to kind of highlight, Jerry, because, like I think this fellow's pretty new member, right? Relatively, and so this what we're here for. We're here to educate, and so one of the things that we are always kind of impressing upon folks is have a plan, and your plan has to have two pieces, right? What's my next line in the sand, and then
Mhm.
where do I where do I look to go from there, right? So it's really kind of a two-step plan. If I'm out, when am I going to get back in, and then what's going to cause me to get back out, right?
Yep. 2 steps ahead
Um,
for sure. Yep.
yeah, I mean, you don't, there's no crystal ball, so you can't really guess when those things are going to happen. But when we say lines in the sand, I mean when Jerry gets, when he's talking about this chart that's getting ready to come up here, that's what we're talking about. Having these kind of lines in the sand, a moving average line, a trend line, something that says, hey, when it crosses this, I'm in or I'm out or whatever, right? Otherwise, you're just kind of guessing where it's going to go. You're not making moves based on what it did.
Right. Right.
And that's the big
So yeah,
difference, right? Guessing versus I responded to the market.
yeah, it's very tricky. I mean, if most of the time people are on CNBC or Bloomberg, they're trying to forecast, and that's what most people try to do. And the big difference between what we do and what virtually everybody else does is we'll listen to the forecasts, and there are forecasts for it's in both directions. So unless you're
But
gonna,
we respond
it's
to price movement, right? I mean, we respond to the data,
right,
and to be fair to the broadcasters, the journalists, quote unquote, they're also trying to
right,
fill air. So you can't
sure,
fill air without forecasting and pontificating and theorizing.
right,
Like it's all, a lot of it has to do with they got to fill 24 hours a day, and we don't,
yeah,
right? So um, talk about that chart.
yeah. So here's the S fund, right? If he's saying he didn't say he got into the S fund in November 2021, but he's saying he's been in the S fund since November 2021. So that was the top of the S fund, the all-time high. And so from the top in November 2021 to the bottom of that correction in October 22 was a 37.5% drawdown. Okay. Um, so that's a big hit to take. If we're assuming a lot from this question, and again, it's not to the person. It's a learning opportunity. If you took the whole drawdown, now the S fund has come back a little bit. So now, as of a couple days ago, I pulled this chart. Um, the price recovered from being down 37.5% to being down about 22.5%. So you made some of your money back. Nowhere near as much as the C fund has, but the S fund, it's coming back. And so the emotion comes into it when you say, all right, I've made this much back. Um, I don't want to give that up. And I feel like the market's getting ready to roll over. So if you say, okay, I feel like the market's getting ready to roll over, and I get out and I go to the G fund, you've locked in these gains, right? So if you feel good about that and it helps you sleep better at night, that's fine. Um, the problem is, what happens if it doesn't roll over, right? What happens if the market keeps going higher? When would you get back in, right? That's always the tricky part. You can make a decision, and like Conan was saying a minute ago, it's basically every decision has to be a two-pronged decision. If I decide in this case, I think this is the top, and I think the market's going to roll over, and I get out and I go to the G fund. If it keeps moving higher, so if my decision was wrong, when am I going to acknowledge or realize or whatever? When am I going to see that it was wrong? And what's the risk reward level when I decide to get back in?
Yeah, and
And
based on that
that's a
chart,
much more difficult.
right? Based on that chart with that trend line, there's nothing there that tells you it's pulling back. Like that's really the problem, right? Is
Right.
that if you're using that trend line as kind of your line in the sand, you crossed it, you're going up, getting out
Right.
as a guess. Now, if it pulled
Right.
back to that line and cracked through it, well, now you've got something to go off of, and that may be a time to get out.
Exactly. Exactly. I mean, the last alert we got out, or we got uh, into the S fund here because it broke to the upside through that channel line. And so I can't remember if we got in, if we added to the position there, but to get out now, I mean, you can do it, but exactly like you said, you don't have anything to work with until you get a close down here below that line. then it makes sense if you're risk averse to get out. But for right now, it's pretty clear that the trend's up. If you want to make the channel really tight, and if it gets outside of that channel, you want to sell it, that you could do that too. But as long as we're in that channel, um, if you're looking to get out, it's really just emotionally driven. And so that again, whatever makes you sleep well at night is what you want to do. But what we're trying to do here is put some kind of guide rails to minimize those emotional decisions. Okay, hopefully that worked well as a educational point anyway. All right, so we have the FOMC meeting this Tuesday and Wednesday. The Fed comes out on Wednesday. We get this 25 basis point rate hike as expected. There was a 99.8% expectation that we were going to get that, and we did get it. What we didn't get that was kind of interesting was there was no dissent among the Fed governors. So each Federal Reserve Bank, the head of the bank is the Fed governor for that region of the country, and then the chairman of the Federal Reserve is like the chairman of the board of all those governors. And so all the Fed governors get a vote, and then the Fed chairman, takes that input, but basically does what he wants to do anyway. There was a lot of talk that there would be some dissension because the Fed has already risen rates so much, and there's plenty of evidence that inflation is coming down, and inflation is coming down enough that they can start decreasing this rate increase cycle that they're on. But strangely, it was unanimous that they wanted to raise another 25 basis points. So anyway, we get the expected move higher because it was expected at a 99% level. There was very little movement in the market between the Fed statement that comes out at 2:00 on Wednesday afternoon and the press conference at 3:00. And then in the press conference, Powell basically kicks the can down the road to September. He reads the exact same statement from July or June, I guess, from June. And in the press conference, he basically says, we have two more big inflation reports and two more big employment reports before that September decision has to be made of whether or not they're going to continue to raise rates in September. And so he basically just kicked the can down the road, and that pretty much set the stage for the market to keep moving higher. So very little volatility during the press conference because he didn't drop any bombshells, and then futures moved higher Wednesday night after that conference, and then the market gaps up big time Thursday morning. But then by the end of the day on Thursday, a bunch of other things had come out. The Bank of Japan did some policy changes. They're going to start doing yield curve control, and there's some other things going on that affected the market on Thursday. And so we had a huge gap up in the morning. Price ran up a little bit to the middle of the day, and then it reversed and came way back down, finished 0.66% down on the day. But so it looked like it was a reversal candle at the top. And when when the market was up big today, if you look at a chart of it, it's basically the market runs up, it knocks out people that are short, it runs back down, knocks out people that are long, and then goes back to even. So we basically finished on Friday a little bit higher than where we finished on Wednesday, but we had a lot of volatility on Thursday. All right, and that affected sentiment a little bit, so I'm going to make an adjustment to the chart kind of on the fly when we get to that, the fear and greed index. But sentiment, so there's basically three categories of it, right? This first post that I'm looking at comes from Charlie Baleo. That's his blog site. It's really good. This is a really long blog. I took pieces of it for the slide deck. What he's talking about here is the AAII sentiment poll. So AAII is American Association of Individual Investors, which is retail people, right? Those of us that are watching this show, we're retail investors, we're not institutions. So what the AAII sentiment survey does is it looks at through a poll whether people are bullish on the market or bearish on the market, right? And so this is going back to 1987. The lows work better than the highs. So when we're down here at big negative low percentages, it's the difference between, so it's the bulls minus the bears. So if we're way down here, there are way more bears than there are bulls. So when everybody is bearish on the market, it tends to be a bottom. And so 1990, we were just coming out of this recession, or just about to come out of a recession. Everybody was very bearish on the market, and it was a bottom. 2009, right? That was the bottom of the financial crisis. 2002, that didn't get actually as bearish as I would have thought, coming off the tech meltdown in 2000. But then 2022, we were minus 43%, right? So a pretty significant low in terms of sentiment by individual investors. Now we're back up to 30, which is greedy. It's in the greed zone. Okay. So what he's saying basically is we're a lot closer to a top in the market, because when sentiment is way up here, it indicates that we're at a top in the market. But again, you can see the bottoms are much more useful because there's fewer of them. You can get up here above 30 and stay there for a long time, and the market can keep going higher. And that's kind of what's happening, right now. We've been in this fear and greed. We've been in a, not on this chart, but you'll see it on the fear and greed index, the CNN fear and greed index. We've been up above in the greed section for quite a while. So the takeaway from this one, we are definitely entering the greed area, and closer to a top than a bottom. This is the CNN Fear and Greed Index. We've looked at this quite a few times before. This was actually from the 25th. So it was the middle of the week. It was before we had Thursday's drop. And so Thursday took us down actually to 78. I think it was 78. And by the close on Friday, I think we had ticked back up to 79. So didn't move too much. Thursday's down day didn't move the Fear and Greed Index too much. But the interesting thing here is the previous close, we were at 82. So that would have been on the 24th of July. The prior week, we were at 83, so even higher. A month ago, we were still at greed. So it's not very often in this Fear and Greed Index that you are in a greed section for a really long time. So again, it can stay there. The market can keep going higher, and this greed number can keep going up. But at some point, it is going to roll over. Doesn't mean it's going to completely collapse, but a correction is coming. It's just a matter of when. It doesn't mean it's going to be the beginning of a big market collapse. It's just we're certainly due for a correction. Okay, so that's the kind of individual investor sentiment. This one, it's from the same article. This one is active manager exposure. So active management is basically it is what we're doing at Grow My TSP. So as you would expect, probably, active managers want to be in the stock market, in this case, the S&P 500 in blue. You want to be in the S&P 500 when the market's moving higher, and you want to be out of it when the market's moving lower. So it makes sense that the active manager equity exposure line moves up and down relatively close to the S&P 500, right? Because managers want to decrease exposure. They're decreasing their exposure to equities when stocks are going down, and they're increasing exposure to equities when stocks are going up, right? And so that's for our purposes, that's what we're trying to do. Where we want to be in the stock funds when the market is trending up, and in the G fund when the market is trending down. So it's a completely different way of looking at things than a fear greed sort of sentiment. Okay, so there aren't a whole lot of managers that are doing this, but that is what we're doing here at Grow My TSP. And then the third one really is large institutions, hedge funds, big money speculators. And so I think I put this one up last week from JC Peretz. Seeing similar sentiment data from hedge funds and other large speculators and Wall Street sell-side analysts, high net worth investors with more than $1 million have the highest allocation in cash. Okay, so that's obviously different than active managers, which are increasing their exposure to stocks, to equities, as the market's moving higher. Hedge funds have their highest allocation in cash, so they are sitting on the sidelines as this market is going higher. Okay, that's what this tweet is saying. We put this one out last week also. It's the same kind of idea from Ryan Dietrich. You got Bank of America Global Fund Manager Survey. So Bank of America is surveying their expert fund managers, and they're saying, where are you? What's the most crowded trade? Basically, where are you positioned mostly? And they are overweight cash, right? And they're underweight equities. So it affirms what JC was talking about on the last slide. The experts are overweight cash and underweight equities, even though the market is moving higher. This one also goes to it, right? JP Morgan asking its people, are you more likely, and asking its institutional investor managers, money managers, are you more likely to increase or decrease equity exposure over the coming days and weeks? And it's been declining, right? As the rally's been going on, it's been declining. And now, as with the prices moving higher, you have a decrease in equity exposure. So now only 17% basically are expecting to increase equity exposure in the coming days and weeks. So clearly the institutional side thinks that we're at or very close to a market top and the market's going to roll over. The individual investors, day-to-day people are full of FOMO at this point, and everybody thinks the market's going higher. So it's a huge disparity between those two, and it's going to resolve one way or the other at some point. This slide pretty much sums that up that Jim Bianco put out last week. The dark blue line is individual investors that are pretty bullish on the market right now. And the light blue line is institutions, and they are pretty bearish on the market right now. So we will definitely see which way it plays out. Someone's going to be right and someone's going to be wrong. And then this one from JC also, even though the NASDAQ had the best first half of the year in history, the experts, right, the institutional investors are doubling down, saying that the second half of the year, they are extremely bearish on the second half of the year. So again, we'll see how this rolls out. But in terms of what it should do for us, if anything, these are the smartest guys in the room by pedigree. Let's put it that way. They're the smartest guys in the room, and they are extremely cautious. So we were talking, I think it was last week, about this idea of aggressive versus kind of conservative for an investing strategy or methodology or way of looking at things. And it's good to know, to have in the back of your mind, that individual investors are, right now getting run by FOMO because everybody thinks the market's going higher. But the smart guys are very cautious about the remainder of the year. And I got two more that don't really apply to sentiment, but I thought they were interesting. The Fed started its rate hike and quantitative tightening cycle, right? Basically April of last year. And so here's where the S&P 500 was when the Fed started tightening. And by tightening, they are decreasing their amount of assets, right? And the myth, right, what Charlie Belillo is saying here, interesting, the S&P 500 is now 2% higher than it was when the Fed began its balance sheet reduction program in April 22, dispelling the myth that stocks need quantitative easing to go higher. One of the things, if you listen to Wealthy On and some of the other YouTube channels, and it's pretty much conventional wisdom, when the Fed starts pumping money into the system, stocks go higher. And the idea is that the Fed needs to pump money into the system at this point for stocks to go higher. And clearly that's not the case because stocks have been rallying quite a bit off that October low, even as the Fed is decreasing its balance sheet. So I thought that was pretty interesting. And then the last one on this, also from that Charlie Belleo blog post. This is the S&P 500, the best performance through the first 136 trading days of the year. Okay, and he's going back to 1928. So 1928 to 2023. 2023, so right now, the year we're in right now, is the 11th best return at 18.9% after the first 136 trading days. And usually what happens is a full calendar year later, the market is much higher. Okay, so this is a bullish place to be. When we're up, double digits after the first 136 trading days, then almost always we're up a lot 1 year later. But what I thought was really interesting, coincidental about this chart, is that that's not always the case, because right behind 2023 was 1929. And 1929 had a great first half of the year, but then the stock market crash of 1929 happened, and by the end of the year, it was 25% down, and a year later, it was 12% down. So while being up 18.9% is great, there are no guarantees that we don't get some kind of major collapse going into the second half of the year, and that's what the experts are basically worried about. Okay. All right. Bonus chart. So everybody knows the FANGs, Facebook, Apple, Amazon, Netflix, and Google. This FNGU is a ticker symbol. It actually has 10 holdings. Twitter, I'm not sure how they are still holding Twitter, but Twitter, all the FANG stocks, Nvidia, and Google has 2. There's 10 altogether, but they're basically the FANG stocks, and it's triple leveraged. So down here at the bottom, put in a bottom in December 2023, right? The Nasdaq did, and the FANGs also put in a bottom there. So this is a daily chart of the FNGU. It's a 3x leveraged ETN, but it's basically the same as an ETF. And so the reason I'm pointing this out is this. A couple things. The low down here was at $40. And FNGU at its most recent high was about 230. So you could have made a killing trading, or not trading, just riding this uptrend if you had gotten in here, obviously, at the bottom in December 2022. For our purposes, if you wanted to, in a brokerage account, or if you can find a mutual fund that's trading in the mutual fund window that's similar to this, if you do an Elliott wave count of this, right, here's the low. 1, 2, this is a 3. We need a 4, which would be like this, and then we should have a big move to the upside. Okay. So the 1 and the 2 is pretty easy to see. 1, 2. Within the 3 wave, you got 1, 2, 3, 4, 5. So that gives us the 3. Okay. 1, 2, 3. And we need a pullback. So ideally, we would get an A, B, C pullback roughly to this area, which was the prior 4 wave, right? That would be the bottom of the 4. And then we'd have a big move to the upside. So personally, I'm watching this chart pretty closely, because if we get a close anywhere between 160 and 180, so I'm really looking at 170, as long as RSI, when this pullback happens, RSI pulls back again to the 50 and we get support there, I'm personally looking to go long FNGU down here with an expected, high up here somewhere around 300. So that would be basically a doubling almost, if it works out that way. So it's not investment advice. Obviously, it's kind of to show the value of the Elliott wave count, and also the importance of support at least above 40 in RSI. If we stay above 40 on that next pullback and then tick higher, you're in really good shape, especially if MACD turns back to the upside. Okay. All right, TSP fund charts for the week. So it is Friday afternoon, and so these are the actual closing prices for the week. And I expanded the chart out a little bit this time just so you could get a sense of where we are with respect to COVID. So here was the COVID low. Here's the high in January 2022. And here's where we are right now. So we got the 20-week moving average line in blue. You don't want to be in the stock funds when we're below that 20-week moving average line. And you definitely want to be in it when we're above that line, right? So the line provides support all the way along. A big breakdown through that line right here. It was a great sell trigger. You get a couple of kind of whipsaws in here, but for the most part, you're out of the stock funds if you're below that line until the bottom here in October. We get back above, and again, we have a couple of whipsaws. Actually, we'd be on the downside. Got a couple of whipsaws here, but for the most part, if you are in the stock funds when we're above that blue line, you're in good shape. So if you're looking at this on a week-to-week basis, as long as you're above that blue line, you are riding the trend either higher or lower. S fund, we kind of talked about it on the example before, but my primary sort of reallocation strategy is based on the stack. Secondary is the wave pattern. And so we had a move down, we have this consolidation, and we broke to the upside. We were already above the 20-week moving average line. So the buy trigger already came and went. But the fact that we got above that August high was reaffirming the buy trigger that happened right there. Right? When we got above the 20-week moving average line, RSI got above 50, MACD had crossed positive. So that was the buy trigger. And secondarily, it was kind of being supported by the fact that we got outside of this channel to the upside. iFund, it has been, we've been talking about this for a while, the 74 level. So the red line is at 73.97, 74. It was resistance here. There was a bunch of support here. And over the last couple months, iFund has not been able to get above it. It did close today, Friday, just barely above that 74 level. And then in the aftermarket trading, it's at 74.45. So technically we are above it, which is really good news. RSI has found support several times here at 50, and MACD is just about to turn positive. So the iFund is looking pretty good. F fund, we've been talking about this for a long time. This was COVID. This was the top in the F fund. You got a 1, 2, 3, 4, and we are in the process of the next leg down in the F fund, which should complete that primary move down, and we should get some kind of pretty big recovery rally after that. But we're definitely not there yet. There's still going to be a lot of people that if you're using a 60-40 portfolio this year, your 60% side, if that was all in the C fund in the S&P, has done pretty well. If a lot of that was in small caps in the S fund, you didn't do as well. But your 40% has not done well, right? Here's January. So you're a little bit lower for the year, but basically, bonds haven't done anything, and they're on a decline. Cannot get above 50 RSI, and MACD is just, it's not collapsing, but it certainly looks like the next big move is down in bonds. All right, questions.
That's a lot of good info, man. I like the sentiment stuff. I always like when we talk about the fear and greed index and those things.
Yep.
I wish they had a way for us to kind of borrow those and put them on our site permanently so people could check in with them. Because and since we can't do that, but if you guys go out and just bookmark it, it makes it a couple more steps to get there. But it's really important to understand sentiment when it comes to the market, because at the end of the day, the market is people. Right. And there's lots of
Yep.
institutional money in there. There's lots of large individual wealth, and of course, right. But at the end of the day, it's human sentiment. It's human perception of what's going on, and all those things that are kind of driving the market. And you can hear it all the time where people are optimistic, 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 and that would translate in this to greed, right? And so
That's right.
you get greedy, you get greedy, you get greedy, and all of a sudden, like that shows you it's coming. There's going to be it's so and not only is it historical data, right, that shows that trend, but and the
Yep.
thing, the reason I pointed out, I like to point out that this is human behavior is one thing that I've learned over 30 years of being like an intel analyst is I don't care how hard people try, we create patterns. We just can't keep ourselves from doing it, particularly when we aren't trying to not do it, right? When you're not even
Right.
cognizant of it, you're definitely creating patterns. And so
Yeah,
all these
that's where the Elliott waves come from.
100%. That's
That's why it
why
works.
it's why I'm pointing it out is for folks that don't really put that together. It took me a while to put that together with what Jerry does because I'm sort of a tech geek, right? I'm a definitely into technology and using automation, but I sincerely believe that you can't replace human analytical capabilities with technology, right? You can support them and supplement them and all that. And so where I'm going with this
Right.
is at the end of the day, what Jerry's doing with technical analysis is basically seeing the patterns of human activity, right? That is human activity in the market, and because humans give patterns, we see patterns, and so
Yep.
that made it all kind of come together for me. I don't know if I'm explaining it very well, but that really started bringing home this whole idea of technical analysis. It was like, oh, all we're really doing is seeing the pattern of human behavior, right? And it just plays out in
Yep.
the market. And so
Yep.
once
That's
you
exactly what it is.
yeah, and once you can wrap your head around that, then I think to me there was like an aha moment, like a light bulb went off, and I was like, oh, okay, I kind of trust this a little bit more because I know that humans behave that way, and so there we go, that makes sense to me. Instead of like this idea that there's this like unknown force, driving
Right.
uh, companies' profits and all those things. No, it's people, it's humans, right? And so that's why I really like the sentiment stuff because it's first of all it's you've got all this data that they've been collecting for decades, so we can look at it and see that on a pattern and go, oh well, not only is the market doing X, but then the fear and greed index is doing this. You got all these data points to kind of support it. So I like that stuff.
Yeah. It's the way you just described it is right on, and I think one of the values of that, of understanding it that way, is that you don't look at technical analysis like it's math.
Right,
That
right,
it
right.
is, it's sort of math, right?
Well,
But
we
when I
use
say that
math
the
to
line in
do
the
the
sand,
analytics. We use math to do the analytics, but it's not math to figure out human behavior and trends, right?
right, right. So you're applying the math to human behavior, which basically means you have to give it a little bit of wiggle room,
Yeah,
right? If you
right,
can say that, you could say that your line in the sand is X, but it doesn't mean like it doesn't mean that the market is immediately going to reverse at X.
right,
It
right.
it just means it's a zone. It's an area to be aware that reversals tend to happen in that zone.
Yeah, and once you get better at it, you recognize your zone, your gray area, if you will, tightens up, right? So your
Yep.
gray area tightens up. I've seen it, with you over a decade or so, or more of watching. Your gray area zone is tightened up a lot because
Yep.
you add enough inputs to go, and you do it enough that you go, oh, okay, yeah, I see enough quickly enough, and that just comes from practice, right? And so
Right.
The folks out there that are listening to all this that are just going right over their head, trust me, stick with it and listen and learn. And all of a sudden, a lot of this starts to become, pretty second nature. And you look at a chart and you see something automatically. I mean, at the end of the day, we've talked about this, and hopefully people haven't tuned out already by now with us talking here at the end. But you see it at the end of the day. You could just take one of these charts and set up a moving average and trade based on that, right? It'd be nice to
Absolutely.
throw in a trend line on top of that. It would be nice to throw in some other indicators that you might understand, RSI, MACD, the ones that we use.
Yep.
But if you don't understand any of that and you're just like, I just want to trade off the moving average, great. I mean, you could even use a monthly moving average. If
Yep,
you
you can.
really wanted to just barely look at it, weekly is probably what we'd recommend, but a monthly would definitely work over a 30-year career.
Yep. Yep.
So anyway, if you guys have questions about any of the stuff that Jerry and I are babbling about, feel free to put it in the comment section wherever you find the video. If there's no comment section, you can always send us an email at support@growmytsp.com, and the support team will get it over to us. We love comments. We love questions because it gives us stuff to talk about. And so we love to get feedback from you guys, even if it's just the littlest thing, right? And so if you like it, share it with your friends. If you don't like it, share it anyway.
All right.
Anything else? Anything else for us, Jerry?
No, I think this market is baffling a lot of people. And the more people that are baffled by it, the more it has a tendency to keep moving higher. It's
Yeah, that seems
it's
to be the
amazing.
case. Yeah, it does. All right, till next week. We hope you guys have a great week, and we are out of here.
Out of here.